Hello and welcome to the weekly roundup today. Ben will be giving us some macroeconomic updates and some color on the recent macro market volatility, as well as what to expect next week. Hello, Ben.
Hi, Eva. How's it going today?
Rainy.
Yes, that it is. That's the summer of rain, I think.
We want the sun back.
Yeah, exactly. I know. Every morning you go out, it's a little bit of rain, but it's good for the grass, I guess.
Yeah, yeah.
Yeah,
The
yeah, yeah.
farmers are happy.
They are keeping everything green. Hopefully that keeps prices down as well, right?
Hopefully. Uh, okay, we'll start with the macros. Lots of news from the BOJ raising rates to weak job data. Any insights on that?
Yeah, so I think that played out. Certainly, that played out over the weekend. Last weekend, Bank of Japan raised into last Wednesday, which we didn't talk about too much on last week's. But
Yep.
so they raised rates into the market not expecting that. It was only about a 30% probability of a rate increase, and Federal Reserve held firm on the Wednesday of last week. We saw chop and volatility into Thursday, Friday. And then over the weekend, this past weekend is where we saw things start to come off the rails a little bit with the market. And Sunday night, the Nikkei was down 12.5% as the yen was rallying. I'll go into that carry trade, what's going on. People borrow in yen, they invest in riskier assets. As that trade starts to unwind, the market started to sell off quite dramatically on Monday. So it was a holiday for us, but equities were still trading. So added to a couple of positions, which we can talk about into that sell off on Monday. And now it's been a big uh, unwinding, peeling that onion back to see like what the damage has been done. It's a temporary. We've seen some bounces, and we can talk about those a little bit as we go through. But I think your last question was more about as well about jobs as well.
Yep.
Um, Canada's numbers came out this morning. I guess the numbers were decent, but month over month was something in the neighborhood of 50,000 loss in jobs for the private sector in Canada, and about 20,000 hires in the public sector. So, that hasn't really changed in about a year and a half, where we've seen this trending. Private sector is laying off people. We see it in the tech space. We had Intel come out with terrible earnings, and they laid off 15% of their workforce. I see a few of the other tech companies in the U.S., but also in Canada, laying off as well. So private sector shedding jobs is not super healthy for the economy. And so, we've had that huge increase in a likelihood that rates continue to get cut for the next couple of quarters.
Okay. Let's go back a little bit to the volatility we saw this past week. Um, is this expected to be sustained? What should we be looking out for in the coming weeks?
Yeah, so we'd come into a period of super low volatility, and I don't think I coined this phrase, but I've always said that stability breeds instability, and we'd gone almost a year and a half of less than a 2% correction, and so as we saw that volatility was grinding lower, and then on Monday we had the highest spike in short-term volatility that we've ever seen in history, followed by the quickest correction in volatility falling on Tuesday. And so it was violent for sure.
Mm.
And, Monday morning, some stocks were down 20%. That's not how they finished for the day. But it's because we had this period of super low volatility. Now we're starting to see it come back a little bit. So do I think it's here to stay? I think the answer is it's probably going to be elevated for now, because we have conflicting headwinds. And so we have a few of the central banks starting to go, okay, well, what do we do now? And with the Bank of Japan deciding whether they're going to raise rates or not further, that's going to continue to, I think, put some pressure to volatility. a lot of pundits like JP Morgan was out saying, 85% of the yen carry trade unwind has already happened, which is probably not true because it took 30 years to build. So I don't think it would unwind in 48 hours. So I think we're probably in for a little bit more chop than we've seen the past year and a half. But we start to see a little bit more normalized, which is we'll say S&P volatility is around 15, and we've been hovering around 4 or 5. So we probably move back up towards maybe more traditional levels of volatility, and that really presents opportunities.
Okay.
Yep.
I do know what in times of economic uncertainties and clients are asking, what should we be doing? Any investment themes we should be focusing on? Any basic strategies? What can you tell us on that?
It's a great question, and I think it's something that certainly we try to do, and we've tried to position for coming into this. And so, defensively speaking, we've done it in a few ways. One of it is owning bonds, which we've talked about, I think, quite significantly over the past 6 months. So bonds really held up quite well as we came into this. You had long bonds in Canada and the US all up somewhere in the neighborhood of 4 to 6%, which gave you some bump and protection. The other thing that did quite well, and I think we talked about this maybe last week or the week before, is can you own some of these stocks even though the market's down and those stocks won't go down with the market? And so, to some regard, that's the case where, for example, BCE, which was and is a name that we've liked, was up Thursday, Friday, Tuesday. So that was an example of where market's correcting. BC's already gone through the pain. They've had, in the previous 12 months, they had to adjust their workforce, cut costs, and earnings came in quite good last week. So it went up into a down market. So that's really what we've been looking at: the defensive names, utilities, BC, telcos, TransCanada, Enbridge. Those names have been stable through here. With the addition of the bonds, I continue to think this is a place to hold some money, and I think they can do well into what we expect in the third quarter, which is the slowing economic activity.
Okay, great. Anything else interesting catch your eye this week?
It's a good question. There was a lot to pay attention to this week. I think the most interesting dynamic probably was the Canadian US dollar. I would have anticipated on Monday with a big correction that the Canadian dollar would have corrected lower as well because commodities, energy, those were down on Monday, but Canadian dollar actually stayed quite stable. And so that's interesting from a perspective of what to do now from that regard. So, we've had a big move where US dollar's up, say, 5 or 6% versus Canadian dollar this year. And now we're starting to go sideways and probably start to cut rates together in the back half of this year. So most of that move probably has gone and happened in the weaker Canadian dollar. So that's noteworthy and something that I'll watch for the upcoming weeks. So that was a bit of a surprise.
Okay. Yeah. Are we going to the charts?
Yes, we are.
Awesome.
So let's see if we're loaded up. Okay, just let me know if you can see that.
Yes, I can.
Okay, perfect. All right, so a couple charts. I think I do 3 or 4 this week, but it's really along the lines of what do we do from here. So ISI Evercore is one of the new research provider that we've had added to National Bank this year. And so they're not new to research by any means, very reputable, lots of history around covering the markets and the economy. But these are really their signals around where they think we are in the cycle. I think it's good, as always, to look at multiple sources, and we do. We use our internal research. We use these guys. We use Hedgeye and Real Vision. So these will be a couple of charts that we look at this week, which is ISI and Real Vision. So these are the signals they look around what's going on in the economy, where are we at? So they look at the company surveys, how optimistic are companies for what's going on, claims, so that would be unemployment is claims, and then of course employment data on the other side of that, spreads in the in credit, and so that certainly is a sign that we've seen this week, the Thursday, Friday, and then again on Monday, we saw high yield spreads widen out. And so that's something we hadn't seen in some time. So, all of these top 4 points certainly look quite weak. Retail sales has been okay in the US. Home builder surveys, housing starts, cracks would be, is there anything else in the system? The unknowns, for example, like currency moves, PMI, which is Purchaser Managers Index, earnings, and copper. A lot of people like to use Dr. Copper from the perspective is it tends to be a leading indicator for what's happening. And so if you've been following this, copper has been correcting for about 6-8 weeks now. So tend to be maybe signaling what's going on with the economy. And so these are the bands which I talk about often as well within how ISM moves. And so as you start to move below 50, which is where we are, you start to approach some of those numbers that would suggest that, maybe we're in a recession or heading towards one. And as the central bank continues to tell us, they think we're probably doing that as well. So our job as investors is always trying to look ahead, what's coming in front of us, not what's gone behind us. And a lot of the economic data is behind us. So the couple of those points that we talk about, a lot of those things are lagging indicators, with employment data being one of the biggest lagging indicators out there. But what really drives asset prices is money supply and liquidity. And so what we've started to see is we've had the economy slowing, but we've had money supply start to increase. So we're always trying to look at how do we think about where we are, and how do we position the portfolios for what's coming in front of us. And so that's these are two real key things that we talk about and think about from an economic perspective. So one of the biggest economies in the world, of course, would be China. And so if we look at the balance sheet for China, typically what they do in the second half of each year is they provide liquidity into the system. And part of why we've seen an uptick in M2 globally, which is total money supply, that's all money in the system, is because China started to increase their money supply, with the Federal Reserve in the US effectively signaling that they're going to do that as well, which is cutting rates. Right now is 100% probability of a rate cut in September, and a 75% chance of 2 cuts in September in the US. We're starting to see this kind of comments around liquidity starting to come back into the system. Quantitative easing, I think, probably happens as well. I'm not saying it's imminent, but I'd expect that to happen if things slow further from where we are today. So this is a snapshot of what China has done, or the Bank of China has done in the second half of each year, which is typically increase their stimulus. And so just a chart around, we talk about Bitcoin as well a bit, and money supply. So if you've looked at how they track, it is certainly an asset that's tied towards liquidity. And so if you overlay this for the last 10 years, as liquidity's increased, so too has the price of Bitcoin. So good chart, certainly something to think about. Not necessarily saying we follow this exact track, but liquidity is a big driver of asset prices, and certainly something that we pay attention to quite closely and try to react to what's coming ahead of us. And if M2 is starting to pick up, then we need to think about what we do from a positioning within the portfolios. That's
Great
it.
charts.
Thank you.
I guess liquidity is the focus for the next coming months.
Certainly is. And so it's a huge part of it. And so, I would have started my business, and you probably would have started your investment career as well, thinking about fundamentals.
Yep.
And fundamentals is different and not as prominent to the decision for where asset prices go. It's much more around liquidity at this point.
Yeah,
Yeah.
absolutely.
Yeah.
What's on the agenda for next week?
Yeah, so I think there'll be a lot of attention towards watching earnings starting to wrap up as we're starting to get to the end of earnings in the US and Canadian earnings are starting to close out. I think the bank earnings come next week or the following one, so we'd be looking at that as they start to close out on that side and see what happens next week because this week was full of chop as the world was trying to digest this carry trade unwind, and so I'd see if that follows through. And we've had quite a bit today, even as well as we've seen markets swing to positive at the pre-markets down into negative mid-morning, back up to positive here this afternoon, where we got the Nasdaq and S&P up about 0.5%. So I'd look to see, does this continue on this chop, and I'd be starting to think about the fact that maybe we want to consider looking to put some protection into portfolios further. But if we start to carry through to the upside, then we'll hold off doing that.
Okay, great. Thank you very much, Ben. As
You.
always, please reach out to me if you have any questions or if you'd like to book a meeting with Ben. Thank you for joining us today and have a great weekend.
Thanks, you too. Take care.
Bye bye.
Bye bye.